Welcome to The Sound of Economics, the podcast series by Bruegel, the Brussels-based economic think tank. I'm Giuseppe Porcaro, Head of Outreach and Governance.
And I'm Guntram Wolf.
And we are here today to discuss the impact of the Covid-19 crisis on emerging economies and the corresponding policy responses. And we are very happy to host from not only the other side of the Atlantic, but actually far west on the west coast, Barry Eichengreen, who is professor of economics and political science at the University of California, Berkeley. Barry is very renewed academics and is an expert on global economics, European integration, and economic history.
Let me also thank you, Barry, for joining us today. I mean, this is great to have you in this evening and this morning for you here in Brussels, in Europe, but also in the World Wide Web. We are discussing today the topic of emerging market economies. Where are they currently in this pandemic and what's going to happen next? We have seen in the last couple of weeks not only a dramatic economic shock to advanced economies, we have also seen that emerging economies have seen a massive capital outflow. The estimates of the International Institute of Finance suggest that more than 100 billion in portfolio flows have been flowing out of emerging market economies in the course of only 45 days or something like this. This is a much steeper decline and outflow of capital than what we've seen in the previous great financial crisis around 2008-9. And we've seen initiatives by the G20. We've seen calls for debt relief, even by Pope Francis, who called for debt relief for the poor countries in the world. So Barry, perhaps let me shoot my first question to you. Where do we stand with the emerging markets, the emerging economies in the world in this crisis? Where are they?
Thank you, Guntram. I think there's an unfortunate tendency for those of us in the global north to pay disproportionate attention to our crisis. The crisis in Italy has been horrific, but there is the danger of an even more serious crisis in the global south. So I think of this as a problem with at least 5 dimensions. You mentioned one of them, Guntram, that there have been these massive portfolio capital outflows in the first month, 5 times the magnitude of portfolio capital outflows experienced by emerging markets in the first quarter of the 2008-2009 financial crisis. So much more serious this time. Secondly, the trade collapse. So everyone is guessing by how much and for how long trade will collapse. But the World Trade Organization is guessing that there will be a decline of 32% in the volume of global trade this year, compared to a mere 12% in 2008-2009. Third, there's the difficulty of doing a lockdown in a country like India. We've seen vivid images of that already, but it's a more general point whether you live in Mumbai or whether you live in a favela in Rio. Number 4, there's the collapse of remittances. So the World Bank guesses that these will fall this year by $110 billion. So again, at least as important as the portfolio capital outflow that you flagged before. And number 5, there's the commodity price collapse. Everybody has noticed oil. Developing countries could see their oil and gas income fall by, wait for it, 50 to 85% this year, according to OPEC. And there are lots of other commodities that will be negatively affected as well. Emerging markets and low-income countries have weaker health systems than the advanced countries. There are 10 sub-Saharan African countries that, as far as I know, with 0 ventilators. 0. They're in the weakest position to win the competitive struggle for PPE. They are in the weakest position to get their hands on vaccines if and when those become available. They have the advantage that they've put in place public health administrations to deal with the Ebola and AIDS epidemics that do them some good, I think, under these circumstances. But they have the problem in the short run of limited fiscal space compared to what we enjoy in the North. They have limited ability to issue and fund government debt in their own currencies. They have limited ability to engage in quantitative easing and expand their central bank balance sheets because of the danger of more currency depreciation, which can be destabilizing given that much of their external debt is denominated in dollars. The external debt denominated in dollars in emerging markets, excluding China, has doubled since 2008. So everybody talks about the end of original sin, the idea that emerging markets can only issue debt in foreign currency. Well, it's ended for governments, but not for the corporates. And now the problems of the corporates have become problems of the public sector as well. These countries, in many cases, have slim to no foreign reserves. So Turkey and South Africa are running out. And I think in the longer run, there are challenges, bleak prospects. Weak global demand will persist. Reshoring and shortened supply chains will hinder the global division of labor. There'll be more impetus in the North to develop and apply robotics and artificial intelligence, which will be bad for assembly operations in low-income economies, meaning premature industrialization. And there will be heavier debts in the low-income world as well. So there's lots to talk about.
Well, thank you for this first overview, Barry, and indeed, very, very big dimensions that you open up here. I took notes: capital outflows, trade collapse, the difficulties of actually doing lockdown, the collapse of remittances, and commodity prices as sort of 5 main drivers that we certainly need to look at in more detail, and that I would love to actually talk about each of them individually. But perhaps before we zoom in a bit more on some of those, I don't think we will manage all of them. Perhaps a general remark. I mean, is this perhaps a description that can be phrased in much more general terms as saying the pandemic actually affects the poor much more than the rich, and including the poor in advanced economies? I mean, the poor in advanced economies, they find it have a much harder time doing the lockdown measures. They don't have a house with a garden. They have to live in a small apartment. They can't get out. They have to go to work because they have no savings. So is this really perhaps a way of framing this also, instead of saying it's just it's a big emerging market problem, it's an emerging problem, but it's really a problem of poverty? Is that a way of phrasing it?
It's a problem of poverty, and it's a problem of inequality. We are reminded of that now every day in the United States, where there are many people without health insurance, where it tends to be the people with the lowest incomes who are on the front lines of delivering the groceries and doing the logistics, partly because they have to go to work to put the basics, to put food on the table, where the wealthier are evacuating to their country homes on Long Island. So in the United States, that has reminded us of the gaps, the holes in the social safety net. What is true here, I think, is true in many countries. So it's true of migrant workers in Singapore. We've been reminded of that case recently as well. And I think it's true of across countries also, that when the pandemic eventually gets to sub-Saharan Africa, we will be reminded that the impact, alas, unfortunately, could be even more devastating there than it is here, where we have stronger public health systems and greater ability to lock down.
Okay, so let's perhaps talk a bit about the issue, zooming in a bit more on the macro finance front. I mean, we've seen the collapse of remittances, which means less funding available for the economies in the emerging economies. We've seen a withdrawal of portfolio investments, and we are seeing also collapse in trade, meaning also less revenues for these countries to actually service their debt. So how would you judge the response, the global response to essentially this lack of fund, both in terms of short-term liquidity, but also probably in terms of longer-term solvency issues so far? I mean, we've seen the G20 giving some debt relief. It's still being debated, the precise outline, but there is some initiative here. We've seen some swap lines, liquidity swap lines, provided to countries like Indonesia, but not many actually. And we've seen, I think, more than 100 countries have inquired and whether or not they could get some assistance from the International Monetary Fund. And of course, the World Bank is also being approached. So on the whole, I mean, how do you see currently the policy response to the emerging markets to this liquidity and solvency challenge of external debt and external equity? And what else should be done?
So the shock, Guntram, that you describe is a sudden stop in capital flows and resource flows to emerging markets and developing countries. This is the mother of all sudden stops. Never in recorded history, I think, have we seen a sudden stop like this. So I have a economic history article from 5 years ago about the sudden stop at the beginning of the Great Depression, called the mother of all sudden stops. This is larger relative to the affected economies. How do I judge the response? Half-baked and underwhelming at this point. The only reassurance is that we're still early in the process, that officials have only begun to recognize how big the hit affecting emerging markets and developing countries are. And historically, we know it always takes them time to get their minds around the problem and organize a response. So what's been done so far is analogous to what was done in the early stages of the Latin American debt crisis in the 1980s, namely to ask creditors for forbearance, in other words, to not demand immediate payment of interest and repayment of principal on what's been borrowed, and to ask banks, where banks are involved, to roll over their maturing loans. So that was what was done at the beginning of the Latin American debt crisis, in the hope that the crisis would be short-lived and countries would grow out of it. It wasn't short-lived, and it wasn't possible for countries to grow out of it. So after 7 years, the Baker Plan was succeeded by the Brady Plan, which recognized the need for debt reduction and converted debt into equity-like basically bonds, but other longer-term instruments. So we're going to have to do debt forgiveness and debt restructuring this time as well. So all that has been done so far is for the poorest countries, official bilateral debts, in other words, government to government loans have been basically halted. China has exempted itself unilaterally from this process. So it has lent a bunch of countries money big time through Belt and Road, but it announced after the Group of 20 meeting that debt relief is not applicable to Belt and Road loans extended by the China Export-Import Bank. So not a whole lot has been done there. There was a call for not only governments, but private creditors to agree to a standstill on repayments. But there's an interesting question about how such a call can be answered and whether there's a way to implement that standstill. The International Monetary Fund has established programs for, I think, 40 countries, 40 at last count, more every day. It has a new facility to basically supplement Federal Reserve dollar swap lines and treasury repos, but only for countries with impeccably strong policies. And a lot of people think that facility will never be used, that countries with impeccably strong policies have reserves of dollars and don't need it, and the rest can't access it. There has been $14 billion of new World Bank funds for crisis relief efforts. So I underline that number again, 14 billion.
If I may jump, there is a listener who is asking how the fragility of the multilateral system affect the possibility of a coordinated response to such a problem with poverty and inequality that you have been outlining just before. And somehow it blends a little bit in what you were telling just before about the reaction of certain countries and the risk that they are here in terms of coordination.
Fragility of the multilateral system is a polite way of putting it.
The listener was a diplomatic one.
Coordination internationally, globally, is fraught under the best circumstances, and these are not the best circumstances. So how we can coordinate on developing a vaccine and on public health responses without the constructive participation of the United States is not straightforward. How we can agree to the IMF providing more resources to countries in crisis through a new allocation of special drawing rights with the active opposition of the United States is not clear. So I think there are a lot of problems we face now, like resisting protectionism on health supplies, but more generally, where we need multilateralism and we need cooperation. And the question going forward, I fear, at least through the end of the year, will be, can the world do what it's done with the Paris Climate Accord, which is to continue going forward even without the active participation of the United States?
But Barry, can I ask you and push you a little bit on the G20 agreement and also on the role of China? Because you mentioned China is not participating in debt relief when it comes to the Belt and Road loans. But China did sign up, in my understanding, to the G20 declaration, which was not an easy thing for China, also given that it has this Paris Club framework of debt relief, which is not really a G20 mechanism. It's much more a G7 and Western mechanisms. So can you just say a few more words on how you judge the degree of collaboration by the G20 at this stage? I mean, is the G20 as an institution perhaps back at this stage, or is that too optimistic of a reading?
I did see this morning when I got up that there's a nice new Bruegel post on this topic, which has a more positive spin on the G20 meeting than I do. It was noted there that the G20 follow-up meeting of leaders, as opposed to finance ministers, was canceled. So what the prospects are exactly is far from clear at this point. I do think the declaration that came out of the G20 meeting that said, we will continue to do fiscal stimulus exactly as we had planned to do fiscal stimulus before this meeting, didn't add a lot in terms of new initiatives, funding new initiatives via the IMF. There wasn't very much there. China, as you say, Guntram, did agree to a G20 declaration that included the notion of a debt standstill for emerging markets and developing countries that need such a thing. And I do think that was a positive indication, given that the Paris Club, which is the venue where governments negotiate with other governments about official debt restructuring, that China did agree to that statement was a positive step. But after that agreement, there were statements by Chinese officials saying, of course, this is correct, but it doesn't extend to Belt and Road initiatives. But the broader question is what the G20 can do going forward. And I think there will be an opportunity for it to make constructive statements and take cooperative action on the trade front, resisting protectionism, on the non-cooperative scramble for protective equipment, on resisting anti-foreigner, anti-immigrant policies that will depress remittances. So I the proof of the pudding is in the eating. We have to see what we can hear.
So perhaps let us zoom in on one other aspect on the debt relief, and you mentioned it in passing, which is the question of the private sector. I mean, obviously, official sector loans are only a part of the debt obligation of emerging markets. These emerging markets have been recipients of private investments. And typically, private investors, of course, don't like to see a haircut on their investments. And if the public sector actually gives debt relief, it can easily be a debt relief that's going to be very beneficial to the private sector in advanced economies, and not at all beneficial to the emerging countries themselves. So I think one key issue is really making sure that the debt relief is not only public debt relief, but that the private sector gets involved. Where do you see us currently on this? What should happen, and what do you think will happen, especially given, as you said, the less than cooperative person sitting in Washington?
The IMF now has a policy of not lending money to countries simply to pay off their bondholders. Money shouldn't go from taxpayers in our countries to emerging markets in order to end up in the pockets of bondholders. So there needs to be a solution of some sort to that problem. The international policy community started about 20 years ago. I smile when I say that because I started writing on this issue and the desirability of introducing collective action clauses into bond contracts 25 years ago. And we've come a long ways in terms of doing that. So the typical problem is that bondholders have to agree to a standstill and a restructuring. And there are always holdouts who rush to the courthouse and try to seize the airliners or oil tankers or bank accounts of a government that stops paying interest. So collective action clauses enabled the majority of the holders of a bond, 70% of them or something like that, to agree to a write down to a restructuring, preventing the vultures, as they're known, from rushing to the courthouse. And there are now aggregation clauses in some bonds that permit one grand vote of all the country's bondholders, preventing a vulture fund from acquiring a blocking minority of 30% of its debt or something like that. There are problems with those aggregation clauses. So I think there still needs to be an alternative to this case-by-case approach. So there is a proposal for someone like the G20 or the International Monetary Fund to establish a central credit facility. This is a proposal that comes out of the Center for Economic Policy Research, where countries would deposit their interest, and that money would be lent back to emerging markets in need until some later date. And the organization responsible for creating that facility, like the IMF, would effectively give the government in question legal protection. I have doubts that that will work legally. The alternative would be for the United Nations to do something here. So back in, I think it was 2003, the United Nations used Article 7 of its charter to shield the government of Iraq from lawsuits by private investors against its non-payment of interest. The UN could take action like that again that might be binding on the U.S. Federal Court for the Southern District of New York, where these kind of things are litigated.
And do you think the U.S. president will be supportive of such UN action?
I think it would be a heavy lift, indeed. Okay. But if I think we should start having that discussion, and if the U.S. is inclined and able to block action by the UN, we're going to have to go with some kind of more ad hoc approach to this problem, like the central credit facility suggested by the CEPR academics.
I would like to ask you something that is coming from Maria de Mertzis. She is asking if you would be willing to take a shot at what a new normal would look like. And she speculates, is it going to be more monitoring and tracking, less international cooperation, more protectionism? What could look like?
That's the big question all of us are asking and none of us can answer. Because the answer depends in part on the virus. Number one, those of us on this call are not epidemiologists. And number two, even the epidemiologists don't know how the virus will be affected by warmer weather, how intense its return will be in the fall, how many times it will return, how long it will take to the discovery and manufacturing of a vaccine. So I think it's very hard to know. My guess would be that the kind of situation we're in at the moment is the new normal, which involves efforts to preserve the multilateral system, including international trade and finance and immigration for work, remittances, but that nationalist forces are strengthened by these kind of crises, where it becomes tempting to focus on helping your nationals, helping your residents, and to point fingers at foreigners as the source of the problem. Every economist I know at this point talks about the importance of massive increases in testing and the ability to trace, to track, and quarantine as a precondition for restoring a semblance of normalcy. And I think it's a precondition in particular for globalization as we know it surviving. Actually, I'm relatively optimistic about some aspects of globalization. In terms of trade, I'm reminded of the conversations we were having after 9/11, where in the United States, lots of people said, now it's going to be too risky to have international air travel and to have large-scale international trade. So for better or for worse, we got the Transportation Safety Administration and figured out how to screen people coming in and into the country. And we figured out how to X-ray containers when they were unloaded at ports. Trade and tourism survived that event. And I think we can use technology in the wake of this one in ways that will be supportive of globalization as well.
I mean, if we can think a bit further ahead, I think you described very nicely the on and off period, and I think this will be a very strange period, a new normal. But let's hope that eventually we will succeed in combating the virus and actually become a world without such a virus, or with the appropriate vaccine, making sure that we are not as vulnerable anymore to the virus. So at that stage, and that to bring ourselves back to the emerging market dimension, I mean, so we will have seen massive defaults in many countries of the emerging market world. I could imagine that in a year's time, let's say at the earliest in a year's time, when we get out of this immediate virus phase, quite a number of emerging markets will have been through some sort of a debt restructuring, and global trade will have taken a very severe hit. How quickly can we think about the resumption phase? I mean, so the advanced economies will provide fiscal support to get a recovery going, more or less strong, and that's the big debate in Europe now. How strong can the European mechanism be so that the European recovery phase is strong? In the US, there will be a recovery package. In the emerging economies, there will be not much fiscal space to do a recovery. There will even be a tendency to go for more self-insurance so that next time you're better prepared. So basically, too little fiscal space, too little spending. So will we see a very subdued recovery, in particular in the emerging market economies?
I do fear that will be the case, that export-oriented emerging markets in developing countries will have a hard time, given that recovery in the advanced countries will be moderate, will be lethargic, in my view, will be sporadic if the virus returns and selective lockdowns and so forth return as well. On the finance side, one thing that the crisis has done, I think, is underscored the desirability of various kinds of indexed debt payments on which depend on the health of the economy, measured in different ways. So people have talked about GDP growth indexed bonds. You pay more if your economy has grown robustly and less if it's not. Bonds, payments on which are indexed to particular commodity prices. Why doesn't Chile have copper indexed bonds? Why don't oil exporting countries have petroleum indexed bonds? I think this crisis is an opportunity to get more of those instruments out there into the market. It's difficult for a country to move in that direction all by itself because it pays a novelty premium in order to do so. because the market for that kind of debt is not terribly broad and liquid. But if a bunch of countries now are going to have to restructure their debts and convert old instruments into new ones at a point in time when we're reminded that the unexpected can happen and that we may be entering now into a even more volatile world than we had before, this is an opportunity to get those instruments into the market, which would be good both for developing countries and their creditors.
Barry, I have a question from Vincenzo Giannone, who is asking if this period is somehow similar to the 1930-45. He's pointing out high level of debt, asset inflation, high income, and wealth inequality. As an expert on economic history, maybe you can have a little bit of a comparison for our listeners as well. So
no Zoom call with me would be complete without a comparison with the 1930s. This crisis is different in many important ways from the Great Depression of the 1930s. This started as a supply shock rather than a demand shock. This crisis started on the real side of the economy before beginning to migrate to the financial side. The Great Depression started on the financial side before infecting, if you excuse the word, the real side. Unemployment went up to 25% in the United States. In 4 years, between 1929 and 1933, we accomplished that, if accomplish is the right word, in 4 weeks this time, rather than 4 years. So there are important differences. I think there are lessons that have been learned from that earlier crisis about responding forcefully with both monetary and fiscal policy. That lesson was embraced to an extent in 2008, 2009, and it's been embraced wholeheartedly this time. And I, for one, think that is all to the good. There are other lessons about the premature withdrawal of stimulus, something we did in the United States in 1936-37, leading to a double-dip recession in 1938. That, too, I think is an important lesson that we want to think about now going forward. People are about to have, policymakers are about to have what Olivier Blanchard at the Peterson Institute calls their, oh my God, what have I done moment, where they realize how heavy public debts will be going forward. And I think there will be a temptation to consolidate before the economy can support consolidation. That's another lesson of the 1930s.
So if we can perhaps spend one moment on this fiscal and then monetary policy interaction, and perhaps zoom in a bit on the US dollar. Of course, one big dimension here is that it's foreign currency borrowing that we are seeing, and it's typically foreign currency borrowing by emerging markets in dollars, right? It's not in euros. So it's in the international reserve currency, which is the US dollar. Part of the issue is in the short term is do the emerging markets have enough access to liquidity, US dollar liquidity? But then going forward, since you mentioned indexed bonds, indexed to copper and so on, I mean, copper prices, you could just as well think of bonds in different currencies, in local currencies, instead of the US dollar. So I guess this whole thing, this whole situation depends also quite a bit and is quite a bit linked to the international role of the US dollar, and the policy response provided presumably will also have consequences on the future role of the US dollar and the extent to which countries will ever be willing to borrow in US dollars instead of borrowing less and borrowing only in local currencies, or perhaps even borrowing in Chinese or European currency. So can you give us a sense on where you see the monetary policy responses to this, and what you would advise the Fed and perhaps also the ECB to do, and where you see the emerging economies after this?
I think the Fed's response in the short run has reinforced the global role of the dollar because it re-extended swap lines to the 4 emerging markets that it favored with swap lines in 2008, as well as to a bunch of advanced economies. It sweetened the terms of those swap lines. The amount of interest that countries making use of them have to pay was reduced further. And for countries that are not favored with Federal Reserve swap lines, for whatever reason, one of the problems is nobody knows what the criteria the Fed uses to choose countries, in fact, are. In addition, the Fed offered a Treasury repo facility. So if a central bank has U.S. Treasuries, it doesn't have to dump them onto the market in order to get cash in dollars, but it can repo them, lend them to the Fed in return for dollars and get them back later. Again, the problem here is this only works if you have lots of dollar reserves. It doesn't help countries that are short. That's where the IMF facility is supposed to step in, but the IMF facility is only extended to countries that effectively have dollars already. So we do have a problem here. I think the only long-term solution is for the world to evolve in the direction of a more multipolar international monetary and financial system, where the structure of the monetary and financial system better matches the multipolar nature of the global economy. That means for Europe that Corona bonds by another name would be positive for the globe, and not only for Europe, because it would create that kind of deep end liquid market in treasury securities that is one of the attractions of US treasury bonds, where Europe has a more balkanized treasury market with different governments with different degrees of credit standing behind their respective national bonds. I was, in fact, on a call with Governor Yi of the PBOC a week and a half ago now, and I suggested that China could be part of the solution as well. China has swap lines, as you know, with a bunch of countries around the world, which it established partly to encourage regulators in the UK and France and elsewhere to allow banks to do more transactions in the Chinese currency. So if they needed more renminbi, they could get their hands on them through these swap lines. I suggested China should up its game and increase its renminbi swaps as well. That would in turn encourage more business in renminbi and central banks to hold more reserves in renminbi, which is another step in the direction of that multilateral system, more multipolar system.
Well, yes, indeed. I think it would be very good speaking as a European, if we had some more European debt fully backed by the ECB, and if the ECB, of course, also extended more swap lines, at least to neighboring countries. I mean, that would certainly be a very positive step for Europe, but also for the global economy. But I think, Giuseppe, we are coming close to an end. Is there perhaps a final question that you want to ask?
Yeah, we're coming close to an end, but I would like to ask a question that received quite a lot of likes on our system, on our platform. Could it be that the emerging markets will just accept the cost in terms of that toll, and in exchange stay operational, while the rich countries will tie themselves down.
So Giuseppe, you have to interpret that question a little bit more.
A little bit. So basically, would we see lockdowns who are going to be ending much faster in emerging markets, and basically in order to keep the economy over there going, and as a counterpart of the fact that economy will slow down more on the global north?
Well, I do think there is a danger that in poor countries, the costs of lockdown will be high because so many people are living on the margin of subsistence, because food delivery systems could be breaking down in the face of these lockdowns. So we have pressure in the United States. Now we have pressure in the inland counties of California to end the lockdown, but that pressure will be more intense, I'm sure, in low-income countries due to the problems I just described. That could be giving into that pressure. That pressure might be irresistible, but giving in could be catastrophic from a public health point of view as well. So what can be done about that? I think there are a lot of cases where low-income countries will need quick help on the public health front. And as I said before, $14 billion from the World Bank is a small down payment on what needs to be done in terms of providing not only assistance to public health systems, but food assistance and the like, which people will need in order to tolerate lockdowns and engage in social distancing.
Thank you very much, Professor Eichengreen. Thanks a lot, Guntram. And of course, we are going to continue these conversations within the frame of our events and podcasts, and also our publications and blogs on the website www.bruegel.org. Until next time, bye-bye.